In June 2026, SpaceX sidestepped the traditional Wall Street roadshow and set a fixed price for its initial public offering, $135 a share. That single number instantly valued the company at $1.75 trillion. Retail demand was so intense that the price didn't stay there for long. Within days, speculative buying pushed the stock to an intraday peak of $225. Elon Musk immediately put that massive valuation to work. He used the newly public stock as acquisition currency to buy the AI coding tool Cursor for $60 billion in an all-stock deal. But the momentum shifted almost overnight. Just weeks after the debut, the stock plummeted 50%, crashing below its IPO price and erasing $1 trillion in market value. The losses hit more than just day traders. Because of rule changes that fast-tracked SpaceX into the NASDAQ 100, passive index funds and retirement accounts were forced to buy in at the absolute peak, just before the floor fell out. How the most anticipated public offering in history resulted in such a massive wealth wipeout isn't a mystery of the market. It's a direct consequence of how this deal was structured. To understand the price movement, you have to look at the float. At the IPO, SpaceX released a microscopic 4.8% of its total shares. When you force global demand through a bottleneck this narrow, the price is pushed upward with immense pressure. That peak $2.7 trillion valuation wasn't a reflection of the company's long-term worth. It was a temporary byproduct of artificial scarcity. The first real check on that valuation arrived with the company's Q2 earnings report. On one hand, the business looked strong. The Starlink satellite division reported 12 million subscribers and is already a profitable, rapidly growing part of the company. But this chart shows the scale of the challenge. While SpaceX brought in $7.8 billion in quarterly revenue, it spent $18.37 billion on capital expenditures. The report revealed that 86% of that spending was focused entirely on AI infrastructure. That capital went toward tens of thousands of NVIDIA GPUs, fueling Musk's ambition to build massive 10-gigawatt AI data centers in orbit. Investors realized that while SpaceX was priced like a mature tech giant at 94 times its sales, it was actually burning cash with the intensity of an early-stage startup. Then came the final pressure point, the August 6th lockup expiration. A lockup prevents insiders and employees from selling their shares immediately after an IPO. On August 6th, 912 million shares suddenly unlocked, more than doubling the supply of stock available on the market. The scarcity that had supported the high price was gone. As traders anticipated a wave of insiders looking to secure their gains, the stock crashed before the first employee share was even sold. The supply constraint that launched the stock also made it fragile. By setting a high initial price on a limited float, the IPO created a valuation inherently sensitive to the arrival of new shares. This wasn't the first time a massive tech IPO followed this trajectory. In May 2012, Meta, then known as Facebook, went through an almost identical cycle. In that deal, underwriters pushed the pricing to the absolute ceiling and expanded the number of shares being sold by insiders, capturing maximum value for the company while leaving very little upside for new investors. Facebook stock spent its first year in a deep slump as the market worried about lockup expirations and the company's ability to earn money from mobile users. The SpaceX IPO followed a similar playbook. It was a successful exercise in financial engineering that secured billions in capital even as the public stock price struggled to find its footing. But a broken IPO isn't always a sign of a broken company. Facebook's early crash eventually provided a massive entry point for long-term believers. For SpaceX, the exit of speculative money may simply be the moment the company's real history as a public entity begins.